I want to ask, first of all, about the truck. It's a little bit confusing that we see the truck driving your results, but also fewer units sold in the second quarter of the new F-150 than you sold of the old F-150 in the second quarter last year. How do you jibe those two things?
Well, Matt, it's great to be with you once again. Actually, in the quarter, which was a record for North America, the F-150 itself did not drive the results because we were still going through the launch at Kansas City in the second quarter. But we do expect in the third and fourth quarters that it will drive positively the bottom line. So that's one of the reasons why we expect an even stronger half in North America and for the company in the second half of this year versus the first half. But customers love the product, and we're so excited about what's ahead for us on the F-150.
It's just, you know, we always hear about how much of your profit is driven by the F-150. 90% is a number that people throw around a lot. And if you're selling fewer of the new F-150 this quarter than you were in the same quarter last year, how is it that we see 44% growth? Where is it coming from, if not the truck?
Well, I think this is a great quarter, which demonstrates that there's more to Ford and there's more to North America than the F-150. The F-150 volume was lower, as you said. Explorer volume was lower because we were also launching the major change for that product. And yet, with a very robust business structure, strong brand, and a strong, broad portfolio of products, you know, we delivered a record profit for the region in the second quarter. So I think it just shows how strong we are beyond the F-150.
What about the pricing power, though, of that truck? I mean, Bloomberg has put out a story saying that you discounted up to $10,000 on it, and that would kind of run counter to other information I've heard, average selling price being $44,100, for example, according to Eric Merkel. Where are you as far as incentives go?
Yeah, let me give you the facts for the F-150. We are at record transaction prices. It's up about $3,600 F-Series, most of that driven by the F-150. Average incentives are about $3,900 across the country, and that's actually lower than a year ago, lower than our competitors. In fact, one of them recently just raised incentives to an even higher level. The $10,000 that was reported by Bloomberg, that happened to be only in selected dealers and selected models on a selected vehicle or derivative of the F-150, which is not uncommon. But on average, we've got these very healthy transaction prices, and we've got the lowest incentives among our key competitors. So it's a very strong story, and the vehicle's turning twice as fast as the overall segment. So it's a very positive story overall for the F-150.
When will, the average vehicle in that segment sits on the lot for what, like 70 days, and you're turning them out in 30?
Yeah, we're doing 32 days, and the average for the segment is 77.
Let's move over to Europe. Off the trucks, you broke even basically in Europe. How do you see that market segment going forward? I mean, are we going to see a continued bounce along the along a break even, or are you going to see a strong recovery? Because I know you expect a rocket launch here in the U.S. after F-150 comes to full production and full inventory. What about Europe?
Yeah, we're feeling quite positive about Europe, and it's for a number of different factors. We did have the near break-even results in the quarter. We're seeing the Eurozone finally show some relatively decent GDP growth rates, UK even stronger. The industry's growing even faster overall. We delivered higher volume. We delivered positive pricing based on the back of new products. So we actually feel pretty good about where we are. Now, in the second half of the year, what we said today is we do expect the second half to be worse than the first half, and that's due to normal seasonal factors in Europe. We have big plant shutdowns, for example, in the third quarter. But we do believe that we're on path towards profitability. There's no question about that.
I know currency took about $2.2 billion out of your revenue figure. Do you hedge against that? Or, I mean, I know you have factory plants built over there. Is that enough of a hedge?
Well, we hedge against some of our key operating exposure, so not revenue, but the operating exposure. So actually, if we hadn't been hedging, we probably would have had better results, because when you've got a strong dollar, you hedge, you're going to have an adverse hedge effect, which actually smooths results. It works the other way when the dollar weakens. So we do hedge, but it's just more for volatility, not to make any type of profit on that. So some effect in the quarter, but it's just a normal part of our business.